captives, and other risk financing options. Traditionally, business and organization have bundled risk by the transfer running it to an insurance company through the purchase of an insured policy or alternatively by retaining the risk and allocating funds to meet expected losses through the arrangement known as self-insurance, in which firms retain rather than transfer risk. During the liability crisis of 1980 century, when business had trouble obtaining some type of commercial insurance coverage, new machine new mechanism of transferring risk developed. Commercial and transference risk developed, facilitated by past of the product liability risk retention act of 1981. These so-called alternative risk transfer arrangement blend risk transfer and risk retention mechanism, and together with the insurance form alternative market. Capitative is a special type of insurance company set up the parent company trade association of group companies insure the risk of owner on heirs. The risk retention group, in which entities in common industry join together to provide member with liability insurance, where fast mechanism to appear otherwise. Other options including the retention pools and large deductible plans to form of self-insurance. Followed ART products such as catastrophe bonds and weather derivatives and micro-insurance programs are also emerging as an alternative to traditional insurance and reinsurance products. Alternative market mechanism. Cap, mm, captives, wholly owned captives as companies set up by large corporation. The finance or administrator risk financing needs. If such a captive insure only the risk of its parent and subsidiaries is called pure captive. Captives may be established by provide insurance to more than one entity. An association of group of companies may band together to form captive to provide insurance coverage. Professional doctors, lawyers, accountants have formed many captives over the years. Captives may in turn use variety of reinsurance mechanism to provide coverage. In particular, many offshore captives as use fronting insure to provide the basic insurance policy. Fronting typically means the underwriting claims administrative functions are handled in the United States by an experienced commercial insurance companies, since a captive generally will not want to get involved directly running the insurance operation. Also, fronting allows a company to show it has an insurance policy with U.S. licensed insurance company, which may need to do a legal and business reason. The rent a captive concept was introduced in Bermuda 20 years ago and remains a popular alternative market mechanism. Rent captives serve business that the unable capitalized captive but willing to assume portion of their own risk and share the underwriting profits and investment income, generally sponsored by insure and reinsure, which essentially rent out thereof captive without having expense of setting up the single parent captive and meeting minimum capital and surplus retirement. Captives have been expanded to employ benefit arena signed to 2003, the years in which Department of Labor gave final approval. Archer Daniel Midland cause plan the government captive is reinsure group life insurance benefit, while the leading domicile for captives in USA government's offshore captives covering US risk are predominantly located in Bermuda, where they enjoy tax advantages and relative freedom for the regulation. The same man in Iceland, Guyson, and the British Virgin Islands, Luxembourg, and Bermuda are also significant center of captives government and a leading domicile for captive in the United States.
Catastrophe reinsurance. Reinsurance for catastrophe losses. The insurance industry is able to absorb the multi-billion dollar losses caused by natural and man-made disasters such as hurricanes, earthquakes, and terrorist attacks because losses are spread among thousands of companies, including catastrophe reinsurers who operate on a global basis. Insurance ability and willingness to sell insurance fluctuates with the availability and cost of catastrophe insurance after major disasters such as Hurricane Andrew and the World Trade Center terrorist attack. The availability of catastrophe insurance become extremely limited. Claims deplete insurance capital, and as a result, companies are more selective in the type and amount of risk the, they assume. In addition, with available supply, limited price for insurance price, this contributes to an overall increase in prices for property reinsurance. Cobra, short for Consolidated Omnibus Budget Reconciliation Act, a federal law under employers with 20 or more employees must offer continuation of coverage to employees who lose their jobs and their dependents. The employee must pay the entire premium. Coverage can be extended up to 18 months Surviving dependents can receive longer coverage. Cell phone insurance. Separate insurance provided to cover cell phones for damage or theft. Policies are often sold with the cell phone themselves. Receive full payment on a loss. For health insurance, it is a percentage of each claim above the deductible paid by the policyholder. For a 20% health insurance, 20% health insurance co-insurance clause, the policyholder pays for the deductible plus 20% of his covered losses. After paying 80% of losses up to a specified ceiling, the insurer states paying 100% of losses. Commercial lines. Products designed for and bought by business. Among the major coverage are boiler and machinery business, commercial auto, comprehensive general liability, director and officials liability, fire and allied lines, inland marine, medical malpractice liability, product liability, professional liability, surety and fidelity, and workers' compensation. Most of these medical coverage can be purchased separately except business income, which must be added to a fire insurance policy. Policy. Contingent liability. Liability of individual, corporation, or partnerships for accident caused by people other than employees for whose act or omissions the corporation or partnership are responsible.